This is the Debunking Economics podcast with Steve Keen and Phil Dobbie.
The Archives.
Episode 137. Fact-checking Freidman.
Milton Friedman, perhaps the father of modern neoclassic economics, the man who called Keynesian economics naive, the man who inspired Margaret Thatcher to do what she did. So how did he convince so many people to see things his way? Well, today on the Debunking Economics podcast with Steve Keen, we debunk Milton Friedman. A bit of fact-checking anyway. How much of what he said actually turned out to be right? I'm Phil Dobbie. That's today on the Debunking Economics podcast. Well, if there was one man who turned so many politicians away from Keynesian economics, it was Milton Friedman. Margaret Thatcher once said that he revived the economics of liberty when it had all been but forgotten. He was an intellectual freedom fighter, she said. Well, as you know, he was certainly a fighter for the free market who once said many people want the government to protect the consumer. A much more urgent problem is to protect the consumer from the government. And he coined the phrase, there's no such thing as a free lunch. Well, of course, you know, unless it's from a food bank, which people are increasingly turning to, perhaps because of the work of Milton Friedman. So just how right was he in all of his thinking? Well, he certainly was a long way right, wasn't he? But let's do a bit of fact-checking on Friedman, given his thinking has influenced the political regime for several decades now in many parts of the world. And interestingly, Steve, until now, perhaps, because Donald Trump isn't following the principles of Friedman. He might be cutting taxes, which obviously Milton Friedman would promote, but he's also introducing tariffs, which is something Friedman certainly wouldn't be a fan of.
No, this is a lot of ways in which Friedman's world, as the textbook, hasn't worked so well when you whack it onto the planet. And all these things which are supposed to happen and makes people a bit better off. The whole idea of privatisation is going to make services cheaper and more efficient. And yes, it'll be a bit painful on the initial stage, but don't worry, it'll all work out beautifully in the future.
Yeah.
Tell anybody that who's hopping onto a British train versus a European one these days. So it's the outcome. But the product has not been as advertised.
Well, on tariffs, he said, because he spoke specifically about steel, if the US imported less steel, foreigners would have fewer dollars, which mean they'd have less to spend buying stuff from the US. And so that would be a bad thing, basically. But the US wouldn't know it, he said, because he talked about things being an invisible way. People wouldn't know what jobs they couldn't have, which is why he says, you know, people support the idea of perhaps putting up tariffs because it seemed to protect the economy. But his argument is that no, there's going to be less money going out to people who can then spend that money to buy from the United States.
Yeah, I mean, if I ever take a neoclassical economist seriously on macroeconomic issues, I might have some time for that proposition. But again, it's the whole basis of this is the whole theory of comparative advantage, and we've had a couple of hits to that ourselves over time. But let's just talk on the empirical data. When you take a look at countries that have successfully industrialized, this includes the United States of America. It is often the case that they'll whack up tariff walls, meaning you can't import the foreign stuff. You're forced to maybe produce it locally. Then you put pressure on the locals, whether that's by the size of the domestic market, as happened in America, or the pressure to compete with overseas products, as the case with Japan. That's what leads to the takeoff. And Michael Hudson, one of my great mates and fellow battlers against mainstream delusions, wrote a book called America's Protectionist Takeoff, very strongly empirically based, looking at the period when America went from being an agricultural nation to an industrial one, and it was behind tariff walls. Danny Roddick's work has found a similar thing about South Korea, of course Japan, and Malaysia and quite a few other countries. The period when they succeeded was when they did the opposite of what economic theory said would work.
Well, he also talked about exchange rates a lot, didn't he? Because, of course, he was instrumental in getting Nixon to float the US exchange rate. And again, that was to do with international trade and trade balance. So he argued that trade balances would never get out of kilter if we had a floating exchange rate. So he gave the example, if Japan could produce everything cheaper than the United States, then the US would buy everything from Japan. And the Japanese would buy everything from Japan as well, because that's the cheapest way to do stuff. But then the Japanese would have a swag of US money from having sold stuff to the Americans that the Americans have been buying. And that would be pretty useless to them so the exchange rate would move until US goods actually became more affordable, which sort of makes sense. What's wrong with that explanation?
Well, reality. Sorry, unfortunately, if you look at the level of trade surpluses and deficits we have globally now, the scale of those is greater than at any time when we had serious tariffs.
Yeah. So that description actually implies that in fact everything is going to reach equilibrium.
Yeah, and that's the old hassle, neoclassical, they'd never seen an equilibrium they didn't like. The only trouble, the equilibriums never actually existed. I remember having a conversation with a New Zealand Treasury economist when they turned down using my Minsky software, despite the fact that the bosses wanted to give it a try. And he's, quote unquote, said, I walk down the street and I see equilibrium everywhere. And I said, including in the car yards? He said, yeah. I said, what do you mean there are no cars left in the car yards overnight? He said, what? And I said, mate, if you're talking equilibrium, you're talking a spot market where the demand is completely equal to the supply and there's no leftover stock the next day. Have you ever seen an empty car yard? So you can imagine how the conversation went after that. But they fantasize about equilibrium when in any dynamic system, any system subject to an external forcing, which is what describes capitalism, because without the sun shining every day, there wouldn't be anything on the planet. Let alone capitalism, then it's an out of equilibrium. And this whole idea that things will push to equilibrium just is ignoring the actual forces that give you a dynamic process.
So in this example there, what happens then? So the Japanese have been buying American goods. They've got a whole load of American dollars. What do they do with it if they're not using it to buy American goods?
They then industrialize and invest and keep ahead of the Americans so that you continue buying Japanese technology, even though it's more expensive. There is no such thing as a car. There is an industry called cars where there's numerous different types. No. They grab one particular part of the market, they push it forward. I remember back in being a kid in the early late 50s, early 60s, and I remember my little kindergarten neighbours chatting about the Ford versus Holden, and everybody talked about buying a Japanese car. They laughed at you. Oh, you wouldn't buy that piece of junk. 10 years later, what was the piece of junk? Now, that dynamic over time can mean that Japan continues getting a trade surplus and the price system does not adjust fast enough. And the vast majority of trading on the currency markets is financial speculation anyway, 20 to 100 times the scale of what happens with actual physical goods.
So they've got all these US dollars. You say they invested in their own country, but they're investing that money. They've got to move. They've got to buy stuff to do that, and they've got American dollars. So presumably they're buying from America in that case.
Well, fundamentally, this is one of my points of contention with MMT. Of course, I agree with them on the monetary analysis of a domestic economy, but they poo-poo this whole thing about running a surplus. And to my way of thinking, trade surplus, when you run a trade surplus, yes, you're going to be getting more American dollars back than you send out to buy, so you accumulate American dollars. What you then do, you whack them at the central bank, and the central bank puts yen in your bank account. And in effect, you're forcing the hand of the central bank to give you local currency, even if the local central bank is caught up with an austerity delusion. And that means you get money to invest and money to expand and to develop your industry over time. So you'll grow faster than the country running a trade deficit.
This is fundamental, isn't it, to the way we have been operating for several decades. I mean, let me give a quote from him, which just to tie off this whole thing about trade balances. So long as you have a free exchange rate, which is free to determine the market price of the dollar in terms of the yen, there's no balance of payments problem. There's no sense. I should do it in his voice, shouldn't I? There's no sense in which the American industry is in danger of being undercut by foreign industries and destroyed. I don't know. That was a crap impression, but you know what I'm saying. So it's this is bullshit, isn't it?
It is bullshit. It's turned out to be bullshit. I mean, this is classic neoliberalism. It reminds me of my favorite joke about Bill Gates. Can I tell a joke?
Yeah, of course. Yeah.
Okay, Bill Gates goes to heaven and he dies and goes into heaven and gets met by St. Peter at the pearly gates. And St. Peter says, "Oh, you're special. You don't. You unlike everybody else coming here, you get a choice whether you like heaven or whether you like hell." And he goes, "Well, okay, all right. I think heaven's going to be better, but sure, okay, show me." Well, he goes to heaven and sees all these dudes in white robes sitting around on clouds playing harps. And then he goes down to hell and sees this, everybody's naked. There's gorgeous women everywhere. There's rambunctious behaviour. Looks fabulous. So I'll choose hell, thanks. And he says, right, off you go. And then he gets down there and finds he's lying on a rack. He's having his skin whipped. There's been vinegar poured into it. And he screams up to St. Peter, what the hell's going on here? And he said, well, that was the advertiser version.
Exactly. It's not exactly what you see on the box. Yeah.
No, it's not worked out anything like what the box said, what the advertising said would do.
But I mean, Friedman took this whole thing about, and it is all about comparative advantage, isn't it? That's, the basis behind all of this.
That's his argument. That's comparative advantage for him. Yeah, which doesn't distinguish him particularly from other neoclassicals, by the way.
Because of this idea that we're going to have equilibrium, and it's all going to be the balance of trade will level itself out. He argued that means the US would always have a steel industry. No need for tariffs because there's always going to be a steel industry, because basically if you produce steel locally, then you're close to the source of supply, the iron ore, you're close to the fuel you need to process it, and you're close to the market, whereas internationally sourced steel doesn't have any of that. Obviously, it might be cheaper because of the exchange rate.
No, sorry, mate. Sorry. You're being far too realistic.
That was his argument, that all of that happens, locally sourced steel can be cheaper than internationally sourced. But internationally sourced steel might be cheaper because of their local conditions, but then the exchange rate is going to adjust that. And that exchange rate means that you're always going to have the benefit locally because you're close to the market, close to the source of steel and all that sort of stuff. That's how
he did you actually write that in his own arguments? That's okay. Because when you look at the theory itself, what it says is that what they call an Edgeworth box diagram showing tastes and production possibilities on the other, taste on one curve, like two boomerangs. And the one boomerang describes people's taste between guns and steel, butter and steel, and another one describes the production possibilities between butter and steel. And where the two boomerangs kiss, that's what the new price ratio is going to be. And then international trade opens it up and gives you a better price ratio. It's all about price ratios in the theory. But when they try to sell this stuff to people who live in the real world, they sometimes make concessions to things that happen there. And of course, those things are genuine. But what has actually happened, of course, is we now talk about parts of America as the Rust Belt.
Yeah. It's not happening, is it? The steel industry isn't happening, and hence that's why we're seeing tariffs put up to try and get it going again.
Yeah, and it's also there's no necessity of full employment either. The other thing, they assume the economy is fully employed. Okay. I had a little fight with the chief of the Productivity Commission many decades ago at a conference I organised when he gave us predictions about what was going to happen to a various range of industries with a 25% cut to tariffs for cars, textiles, clothing and footwear. And he said, assuming good macroeconomic management. And I asked what that meant, and the answer was, as full employment is maintained despite the tariff change. Now, people think that this stuff takes into account what happens to unemployment if you change the tariff. No, it assumes there's no change to unemployment. The economy is fully employed. Total bullshit. The sort of thing you can get away when you're doing your advertising, but of course you end up in hell. Right.
So another thing he said was a balance of trade deficit can be a good thing, and often you do often hear that they're buying more. We're buying more imports. That means the economy is going well. The domestic economy is going well. So he said the US has a balance of trade deficit because of foreign investment. People are buying US bonds, for example, which is helping the economy grow. So that's a good thing. So if that is the case, why would America be worried about the investment from China, which sees a huge trade deficit for the United States, and which has got President Trump so riled? If you listen to Milton Friedman, he wouldn't be the least bit concerned.
Yeah, I know. Again, this is just the whole thing about believing that in the long run, everything balances out to zero. So again, the belief in the neoclassical thinking is they're running a trade deficit now. It's because you're importing productive goods, which you'll then use to produce the trade surplus in the future. Well, that's, in the long run, that works. And in the long run, we're all dead. In the long run, Australia's been doing trade deficits for 40 years. America's been on a continuous trend towards it. Japan and China have had continuous trade surpluses. It just doesn't happen. Again, this is fantasy belief in equilibrium, not just at a point in time, but through time.
Well, doesn't it balance itself out, actually, that those foreign countries just buy up more of your country?
That's what's been happening. And of course, that's you end up with a country full of workers and no capitalists, which is, in effect, what's happening with Australia. And it means that if you don't get the distribution of income towards going biased towards your workers, you're even worse off because you don't have any domestic profit, you don't have any domestic investment.
Yeah.
And that is what it is a major problem.
Well, that gets back to Milton Friedman's point about, well, if you're getting people who are buying a whole load of your goods, they've got, or you're buying, if Japan is selling a lot of stuff to the United States, then Japan has a lot of US dollars. What does it do with the US dollars? Well, look at what China's doing with it. It's using it to buy bonds in the United States. So it's buying up government debt, but also buying up bonds in companies as well. So that's what they're doing with their money. They're buying your country from you.
Effectively buying shares in the corporations as well. Like a classic for Australia is Vegemite is not owned by an Australian company.
Yeah. Strange you wouldn't mention that as a possible alternative. Yeah. So what about countries like Japan dumping goods below cost? And China's been doing this as well. The unfair competition argument. He said it's a good thing if the Japanese government is so ill-advised to tax its taxpayers in order to send it to us at below cost, TV sets and other things, then he says, it's what nation would refuse what he called reverse foreign aid?
Yeah. Again, there's a temporary benefit for that, but if it undermines your productive capacity, then at a later stage, you've lost an industry and you won't necessarily get the workers to be employed where they get shifted to later. Joe Stiglitz did some good work on this, I have to say, in his book, Globalization and Its Discontents, because he said this was always the argument being made by the World Bank, that if you liberate people from one industry, they'll move smoothly to another industry. And he said in practice, when he went to check out what happened when some tariff change was changed that made Japanese textiles cheaper than locally produced textiles, he said the textile workers end up in welfare or begging on the streets. It wasn't a case that they moved smoothly somewhere else. So again, this fantasy belief in smooth movement in capitalism and ignoring that you can't retrain a blast furnace to make clothes, and you can't, when you retrain workers, it takes time and they might not actually ever have the skills nor be in the right location. So you start dislocating and destroying communities as well.
Well, is that what I knew you'd look at what happened in the UK, of course, when, Margaret Thatcher closed down the iron and steel industry and the shipbuilding industry in the north of England. There was huge suffering because it takes a long time to replace those industries and still haven't been replaced. And is that the problem with Friedman? It's all short-term thinking. It assumes that equilibrium will somehow be reached and it'll be reached instantaneously with no human suffering in the process.
Yeah, it's all microeconomic thinking as well. I mean, the whole argument about getting rid of trade unions is all this belief you have a perfectly competitive bunch of firms buying off organised labour, and if you get rid of the organised labour, you reduce the wage back to what the workers should get and increase employment as well. And they ignore the fact that in the real world there are organised employers as well as what used to be organised unions. And even according to conventional theory, what's called the theory of the second best, it's a bad idea to abolish either trade unions or monopoly buyers of labour, powerful buyers of labour, if they both exist. So the theory and the reality, again, it's heaven versus hell from Bill Gates's point of view.
So can we find stuff that Friedman was right about? So, for example, when he got Nixon, after 25 years of a fixed exchange rate for the US dollar, the idea that it should be floated, that was a good move, surely, wasn't it?
Yeah, relatively that was, but I would prefer to see bringing in Keynes's idea of a bancor, which is like an adjustable fixed rate of exchange. So the whole problem was the American dollar in the first place, and I can't blame that on Milton Friedman. That's Harry Dexter White, who was the American negotiator at the Bretton Woods conference and turned down, just overwhelmed Keynes's argument for a non-national currency to be used for international trade on the basis of we're the biggest country on the planet, we can kick sand in your faces. Aren't we great? And I think that's actually a major factor that's led to the destruction of American manufacturing over time.
And he was a firm believer that government shouldn't play in the foreign exchange markets to try and moderate currency movements like we see in China. So they shouldn't buy and sell currencies to protect their own domestic currency. I mean, hard to enforce unless you introduce some sort of international law. But I mean, that does mess with the idea of the floating exchange rate, doesn't it?
It messes with the idea of a fixed exchange rate as much. With a fixed exchange rate, you can run out of your own currency in that sense, so you can run out of the backing currency you need. And that's what Soros used to blow the English economy and make the beginning of his fortune, because he knew that he could borrow money to buy American dollars he didn't actually have in that sense in a limitless way, whereas there was a limit to how many American dollars the British could buy themselves with their own currency reserves. They couldn't defend the fixed exchange rate. So it works. The floating exchange rate is a good defence against that sort of behaviour.
So he's best known perhaps for his quantity theory of money, isn't he? You know, this idea that inflation comes from the amount of money that's in circulation. So it's not necessarily money from the government. Well, what does he mean by this? He says it's not based on the supply of money from governments, but on the demand for that money from consumers.
Oh, his theory of money is that's what his idea of helicopter money. The one thing I'll thank him for is using the term helicopter money, which legitimised me talking about it. Which would have never have happened otherwise. So what he really sees as money is external to the economy. It's not created by the market system. It's created by the government. And it only expects the rate of inflation beyond a certain level. He was actually in favour, by the way. This is what people don't realise. When you don't realise the originals, you don't realise this stuff. He was in favour of the money supply contracting at about 7% per annum.
Of the money supply contracting.
That's what he wanted. Right. His preferred policy. This is in the optimum theory of money, optimum quantity of money paper. We ended up saying a 2 or 3% increase in the money supply was probably politically palatable. But he thought the economically best situation because it would increase
the value of the money.
Yeah, that's right.
It would keep prices down, in other words.
He was actually in favour of, literally talked about money furnaces, burning money, and he reckoned we should burn 7% of it every year.
That seems a hell of a lot. And for an inflation rate of what? What was he? So he was doing that because he'd say we'd have a sustainable inflation level if we did that.
Deflation, because prices would have to be falling in that situation. So we'd be gaining from the deflation, which of course only works if you don't have any private debt. And here we are back in the same old bloody blind spot again. The reason why I talk about it so much, he literally didn't even consider that there was private debt going, and therefore if you had deflation, your capacity to service that debt would be falling over time while your debts rose in nominal value, right? Which is what gave us the Great Depression.
But you've got less notes. Each note would be worth more.
Yeah, that's the idea. The trouble is at the same time, what are your debts? So your debt's nominal or real? And again, the debts are denominated in actual dollars. So what would be happening is that was a 7% real rate of interest on any outstanding debt, which he ignored.
Right. So just explain how that influences debt levels then.
Because if you owe $100, okay, and you've got to pay 5% interest on it per year, or 10% interest, let's say, and then the dollar itself is falling at, say, 10% per annum, you're earning 10 one year, 9 the next, 8, a bit less than 8 the year after that. Yeah. Therefore, you can't service your debt.
Right. Got it. Okay. All right. So he was also against, he really was, the power of the free market was in everything he wrote about, wasn't it, really?
Yeah.
And I think, do you think part of the reason he was so successful and got so many people on his side is because he did have a knack, didn't he? He did a lot of video and TV appearances. He wrote a lot. He was clear in his thinking. I mean, you can argue against it, but he was very clear in his presentation. Perhaps it was because it was so simplistic. And that's why he got so much traction. I mean, if you watch videos, it's actually quite compelling. You can see through it, but you can understand his logic, and he does it in a very coherent way.
Yeah, it's a major point of being a good media performer. It does have an impact, and he was a very good media performer. Even the fact he looked so quirky was the thing that he actually put in his favour. A bit like, I don't know if you're old enough to remember Brio Santa Maria. Did you ever watch him?
No, Mongo Santa Maria, but no, not Brio. No,
he was a right-wing commentator back. He was Tony Abbott's hero, and Brio Santa Maria used to run a regular piece. It was all about commies coming down. Gravity was going to cause yellow commies to pour onto the Australian continent. I always thought it was interesting that gravity meant it went from the people fell from north to south. But this vision was a compelling argue he was such a compelling personality, how he put it across. And definitely Milton Friedman had that on his side.
Well, let's go through some more of his theories and comments he made. So just regulations generally, not necessarily talking about money, but regulating any industry, like professions like lawyers, accountants, doctors. If you introduce those regulations, then you restrict competition, so that puts up prices, so people end up paying more, they get a worse service as a result. Less regulation has, I'm not sure, I don't know what that means, like doctors haven't been trained perhaps, but less regulation has the opposite effect. He says that's the power of the free market.
Yeah, again, there's a point to which that argument makes sense. You can get totally tied up in red tape, as they say, and certainly working in the university sector, that's one thing that drove me absolutely crazy, and I couldn't wait to get out. So that is a point. But he pushes it too far because, again, let's look at regulations, for example, building cladding. Yeah. Let's make it less expensive. Let's put it that. There's nothing wrong with flammable cladding. Okay, and the market will sort it out. Oh dear, 300 people die in a fire. Yeah. And every building in the country has to be revised so the same thing can't happen in that country.
And guess what?
Slightly more
yeah, and it hasn't. I mean, they're still up there. That is the painful thing about that whole experience.
Yeah.
Still loads of
them. The Grenfell disaster is an example of what happens when you don't have regulation. Yeah. On a much more trivial notice, because I have to use the internet massively with my work, as you know, and I was getting sick of the radio transmitted internet signal I was getting in my property in Waterloo, all of it, literally a kilometre from Big Ben, and I wanted to get cable and found that the building, which was built probably in the 1980s or 90s, I think, had no internal provision for cable. So I'd have to, as a tenant, get the companies to drill a hole through the bloody wall. I mean, if you put regulations saying you've got to have telecommunications conduits or conduits in general that pass signals from the outside to the inside, that regulation ends up saving money.
But there should be a whole load of competition. There's be loads of people prepared to do that at a very low price because of competition.
That's right. They go and drilling holes in walls all over the place.
Yeah.
Again, it just doesn't work that well. The regulations can, in fact, inspire competition. And that, again, like you can see that even if you look at things like the evolution of new racing formats, car racing. You've now got electric car racing regulations are put in. You can't have a petrol motor in your electric car. Sorry. This sort of thing then inspires innovation in terms of electric car design. So regulations can be creative to a certain point, putting pressure to innovate. But I agree entirely, and I've certainly experienced it. You can be tied up in
overregulated. Yeah. Okay, here's another one which we hear time and time again in discussion about rents and house prices. Artificially constraining rents, keeping the price down, is going to make landlords less willing to rent out the property, which is going to reduce supply. I'm not really quite sure how. Are they going to just burn the rest of their properties? Prices won't be able to go up, of course, but quality will go down, is his argument. But as I say, what happens to the rest of the properties? Do they sell them? In which case they have to sell them at a discounted price, which means someone will be able to buy them cheaper and won't need to rent.
Although, again, if you look at the state of housing, probably one of the best countries in housing in the world is Singapore, and the huge part of that is state-owned. Yeah. And the UK used to have the same thing, the old council flat. The privatisation of that is a large part of what gave the private debt bubble that did, again, something Milton ignores, that drove private debt from 55% of GDP when Maggie was in first deregulating the finance sector to 193%. During the financial crisis.
But he's also ignoring what happens to all those other houses. He's saying if you keep the price down, landlords are going to rent out less properties. Well, that's fine, but what happens to all the other properties? And he doesn't talk about that.
There's a very partial, convincing partial logic. I call economics a shell and pea game. The whole idea of moving the shells around so you don't know which one the pea is underneath. Yeah. Or hiding the pea on top of one of the shells and not telling anybody. That's the other story. So there's so much of this to conventional economic theory, and Milton was just the past master at pumping that stuff out.
So he was confused about whether tax prevented inflation or encouraged inflation or had no influence. So he wrote a paper during the war taxing to prevent inflation. So in other words, if you took more money out of people's pockets, then we'd have less inflation. but then he later argued that tax had no impact whatsoever. It was all to do with the supply of money. At what point was he right? Or in neither case?
Well, in neither case. The tax one is actually fairly sensible, and that's, again, the modern monetary theory argument that what tax does, tax isn't necessary to fund government spending.
Yeah. Well, early on he was influenced, wasn't he, by John Maynard Keynes? I mean, he says
no, I don't know that he ever read Keynes. I mean, he said what he called Keynes certainly wasn't what Keynes wrote, but he was influenced by the Chicago Plan. Yeah. So he was one of the ones who came in favour of the Chicago Plan, saying that the government should create all the money in the economy, not the private banks. And this is after the Great Depression. So in some areas, reality did intrude into his mind.
Well, on the Great Depression, he said, like most other periods of severe unemployment, it was produced by government mismanagement rather than any inherent instability of the private economy. So it was all basically government spending is who is responsible. It creates runaway booms that will eventually lead to a bust. It's all the government's fault.
No, in fact, that's more Hayek's argument. What Milton actually argued was that the crisis was caused by the central bank, the Federal Reserve in this case, not creating enough money in 29 and 30, 31 and 32, and he blamed the Federal Reserve for cutting the money supply when it should have been expanding it. And that's the argument that Ben Bernanke came along and regurgitated as well.
I thought he wanted to cut. I thought he wanted to reduce the money supply by a certain percentage every year.
I know he's fully politically palatable. He said it had to be 2 or 3% increase was necessary.
Right.
And if you look at the stats, there was a period 29-30 where the Federal Reserve was not increasing the money supply as fast as Milton would argue. And this is what Bernanke used to blame the financial crisis on the 29 crisis, the Great Depression, on the Federal Reserve. Ironically enough, he neglected the same issue in 2008, and the rate of growth of the money supply with the Federal Reserve can actually control, the M0 level, was falling as the crisis hit. And then he pumped it up to unheard of levels, trying to prevent the crisis. So this was a fallacy. Again, Milton ignored the role of private debt and private credit, and so did Bernanke. So you see Bernanke arguing that he rejected Fisher's debt deflation theory of the Great Depression on the basis of, and I pretty much quote, absent implausibly large differences in marginal propensities to spend, debt deflation is a pure redistribution which should not have any significant macroeconomic impacts. And you look at it and you think, don't you realise that when people go bankrupt, they don't pay back their debt?
Mm.
You know, even that point alone was missed by him. So in this way, I see Bernanke as the shadow of Milton Friedman. And again, they were just putting about a totally false line. When you go back and look at the data, what they ignored is what caused the crisis. And in terms of his own data, when he wrote a book called The Monetary History of the United States of America, working with Anna Schwartz, and there's a lot of good empirical work in that volume. But at the same time, he's trying to fudge the numbers so that the velocity of money appeared constant. Now, when you take a look at later researchers looking at the same data and also looking at more recent data, the velocity is highly volatile, falls during slumps, rises during booms, and has had a long downward trend ever since private debt hit. This isn't private debt. It was ever since Volcker drove inflation out of the economy by bumping up rates to 17% back in the early 80s. And ever since then, the velocity of money has been falling from 3.5 to about 1 now.
Yeah.
So, he's saying that's stable. Give me a break.
Mm. So let's finish then. One last one. As we fact check Friedman, he wanted to introduce a flat rate tax. And his argument was that richer people didn't hang on to their money and spend less proportionally than poorer people did. Everyone basically spent the same amount of money. He said progressive tax is a retrogressive measure in terms of the impact on the economy. Everyone should be taxed at the same rate. And he said, people at the top rate pay lower tax anyway because of loopholes. So at the time, the tax rate when he was saying this, the tax rate in the United States went up to 70%. Of course, it's all come down now, but it went from 14 to 70. He reckoned if you took all of that income and averaged it out, you'd have a tax rate of 19%, and that would be better for the economy. Although not so good for those people going from 14 to 19%, of course.
Mm. No, again, I mean, I'm a critic of income tax for a range of reasons, mainly because when you look at money, you look at it from the point of view of saying taxation takes excessive money out of the economy to avoid inflation, money created by the government. Then you have to say, well, what's an effective way of doing that so everybody pays? The burden of taking the money out doesn't fall on one class rather than another. And with income tax, nobody likes paying it. And everybody's trying to evade it, but the only ones who successfully evade it are the wealthy.
Yeah.
So you get the situation where the poor end up paying, and the middle class in particular, who can't afford to pay their way out of it, end up paying a far larger proportion of what's actually taken out as tax than the upper class do. And that is a huge form of social discord. So I'd rather go to a transactions tax. And that, again, would need to be a flat rate. So, I'm not totally opposed to Freidman on that particular point.
But the idea that the people at the top end are spending proportionally the same amount as poor people.
Total crap. Yeah. I mean, what they're spending, they're buying financial assets with it. They're buying ownership of capital. There's no Bozo is not spending, though he may be a divorce case coming up pretty shortly. He's not spending the same proportion of his 160 billion that a worker spends of their 100. There's a far higher rate of turnover of the existing money for the working class than there is for the wealthy.
So it's interesting. Most people would say, well, Freidman still has a big influence, but as we started out, not with Donald Trump.
Yeah, and this again is because it's you've ended up in hell rather than heaven. So your policies to address what's going wrong aren't the same as they'd be if you actually lived up in the heaven that this was all going to talk about. I mean, if Milton Friedman's ideas have been right, there'd be workers luxuriating in America in service jobs because that's where they move because of the exchange rate differences. Prices would be lower for everything. Things would be more efficient than they are with state ownership, yada, yada, yada. That ain't the real world. And when you come to living in the real world versus arguing for a fantasy world, the fantasy, when you enact the fantasy and you get it, that heaven becomes your real world rather than hell, the fantasy doesn't look so great anymore.
Well, yeah, and he was really a man based on theories, wasn't he? I mean, he wasn't a mathematician in any sense. He wasn't building complex models. He was a man who basically delivered theories and perhaps didn't need to back him up with facts.
Oh, you said there's a lot of faux mathematics in his papers, particularly optimum quantity of money paper, all these calculations of the marginal utility of money and the marginal rate of substitution between money and other commodity and other goods and so on. Just hilarious. Crappy stuff pretending to be mathematically sophisticated, but not a complex model. I don't think there's ever a Milton Friedman macroeconomic model.
Right, we'll look at more economic models and how they relate to the climate next time, because we're going to look at Nordhaus's climate model and have a go at debunking that. That's next time. Good to talk, Steve.
Okay, mate. Talk to you again.
Steve Keen, the economist, of course, debunking much of the work of Milton Friedman, but not all of it. And that's it for the Debunking Economics podcast for this time. I'm Phil Dobbie. Catch you again next week. Thanks for listening. If you've enjoyed this podcast, then please share it with your friends, like it on YouTube, and subscribe to this channel.